Hello everyone and welcome back to this series of videos on the Solow growth model. Specifically in this video, we are going to expand on what we did in the previous video where we derived the capital steady state, and we are actually going to derive the output in the steady state, of course, still using a Cobb-Douglas function. So, what do we need? What is the toolkit that we need to use in order to derive this output per worker in the steady state? First thing first, we need the steady state capital stock per worker, the one that again we derived in video 18. And specifically, we found out that in the steady state, capital is equal to the savings rate over the depreciation rate, everything to the power of 1 over 1 minus the capital share. And then the reason why we need the steady state capital stock per worker is because the output is determined by the production function. And production function in the steady state gives us output in the steady state. And what do we need to find output in the steady state? Well, according to our Cobb-Douglas production function, we just need the level of capital in the steady state, everything to the power of alpha. Again, the reason why we don't see L, which stands for the labor force, is because we are looking at per worker equations. So even if we don't see it, it's still embedded in these variables. So it's as if we are looking at aggregate variables, such as big K or big Y, everything divided by L, by the workers. So now it's quite intuitive that since this is how we determine output and we need capital in the steady state, we will need to plug in this equation into here. And that's exactly what we're going to do. It's one simple step. So we're going to say that our output in the steady state is equal to savings rate over depreciation rate to the power of 1 over 1 minus alpha, everything to the power of alpha, because this is our K star. Now, what do we do when we elevate a power to another power? So we multiply them according to the law of indices. So we need to do alpha times 1 over 1 minus alpha, which is going to give us alpha over 1 minus alpha. So this is to say that our steady state level of output per worker is going to be savings rate over depreciation rate, everything to the power of alpha over 1 minus alpha. And this is our key equation. This is how much capital we are going to have. Apologies, this is how much output we are going to have when we are in the steady state of our economy. So this level of output is constant. It doesn't grow anymore because we know that in a steady state, variables don't grow. So this equation describes the long run level of output or income, depending on how we want to define it, per worker that an economy can sustain when the capital per worker has reached its steady state. When I write SS, I mean steady state. And when is the steady state reached? If we think again in theory terms, when investment exactly offsets the depreciation. And this concept can very easily appear also from this equation because we can see, and also from the capital in the steady state equation, because we can see that what's involved is the savings rate, and we know that in this type of model, we are assuming that savings are equal to investment, and the depreciation rate. So let's actually interpret this equation So we've seen that the steady state output per worker depends on three key parameters. Firstly, the savings rate. And why does it depend on the saving rate? Well, because a higher savings rate is going to increase the steady state output per worker, as it's on the numerator here in our equation. So if this increases as well. Because more resources, if basically more is saved from what is produced, more resources are allocated to investment. And this allows workers to basically accumulate more capital and become more productive. Then, in the denominator of our equation, we've got the depreciation rate. And this is the second key parameter. So a higher depreciation rate, though, is going to decrease our optimal level of output in the steady state. Of course, if this goes up, the denominator in the fraction is bigger, meaning that the whole fraction is going to go down and hence output is going to decrease. So basically, the reason why this happens intuitively is because, of course, if we have a higher depreciation rate, it means capital is going to wear out more quickly. Machines break more often, basically. So it's more hard, it's harder, of course, to maintain a high capital stock if machines break every day. And then the last parameter that we are interested in is the capital share, this alpha that appears in the power of our equation. So basically, the capital share in general determines how strongly output responds to increases in capital. So how strongly output responds to increases in capital. And the larger is alpha in general, so as alpha increases, the greater the effect of saving is going to be, so the greater the effect of saving and of capital accumulation is going to be on long run output. So we are going to have a higher impact of savings and hence capital accumulation on long run output. Note that this exponent here exactly reflects the presence of the diminishing marginal returns. What do we mean here? We mean that we know that in our Cobb-Douglas production function, it exhibits diminishing marginal returns with respect to its factor inputs, meaning that each extra unit of capital that is added is going to be less productive than the previous one. So, of course, let's say capital accumulation is going to raise output, but we know that the output increase is not forever. We were going to reach a steady state, right? And specifically, the steady state is going to be higher if capital contributes more to, let's say, the output production. So if savings have a higher impact basically on the output production, then this alpha is going to be larger and it's going to reach a higher steady state, however, like compared to before. However, the presence of this fraction and the fact that alpha we said is less than 1 allows us to conclude that each extra unit of capital becomes progressively less productive and as basically the capital stock grows. So if we want to draw a takeaway, so why did we talk about this equation? Why is it useful? Well, it is useful because it allows to predict differences in the long run, income levels across countries. The fact also that we are using per worker variables is exactly what allows us to make these international comparisons. So now that we've seen all of these algebraically, we are going to move on to a graphical representation of the Solow growth model. And this is going to be seen in the subsequent videos.